So now let us go to the next stage, that is stage 1, called as capital budgeting concept. Please. Shh. Can I proceed up? Now. Write down. Give the heading. Special issues. Special issues or special concepts in capital budgeting. 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 Okay. We'll have a checklist. What should we discuss? And then we can just discuss this another 2 classes or 3 classes. Can we start or not? Then we'll be left with only capital budgeting under uncertainty. Once they complete that, we can move on to the derivative segment. Can I proceed? Now, write down. Point number 1. Point number 1. Sensitivity analysis. Point number 1. Sensitivity analysis. Point number 1. Sensitivity analysis. Point number 2. Capital rationing. Point number 2. Capital rationing. Put a hyphen and write idle fund situation. Capital rationing. Put a hyphen and write idle fund situation. Idle fund situation. Point 3. Point 3. Inflation in capital budgeting. Point 3. Inflation in capital budgeting. Point 4. Overseas capital budgeting. Point 4. Overseas capital budgeting. Point 5. Life disparity problem. Point 5. Life disparity problem. Point 6. Abandonment and life disparity. Point 6. Abandonment and life disparity. Abandonment and life disparity. Point 6 or 7? 7. Sorry, point 7. Timing disparity. Point 7. Timing disparity. Bracket la modified NPV. In bracket write modified NPV and modified IRR. Modified NPV and modified IRR. Point 8. Point number 8. I have to check out the concepts here and then I left out. Okay. Base case NPV and adjusted NPV. I am dictating a syllabus here, okay, don't say like that. Base case NPV and adjusted NPV. Point number 7 or 8? 8. Point number 8. See, you should tell good morning, yeah. Point number 8 or 9, other you tell me. Okay, point number 9. Base case NPV and adjust. What, yeah? Base case NPV and adjusted NPV, 1 point, yeah, okay. Huh? Have you written or not? Okay. 8 point is base case NPV and adjusted NPV. 9 point, please. Long-term fund approach versus equity shareholders approach. Long-term fund approach versus equity shareholders approach. Long-term fund approach versus equity shareholders approach. Okay. In this, these are all the learning objectives I want to cover in the slot called as capital budgeting issues or concepts. We have already covered life disparity and then abandonment during the Pongal class. I don't know, so already covered that. Others you can just check from the friends. Okay. These two has been already covered. The remaining needs to be covered in this segment. Can you start or not? Now. Today let us do the first area called as inflation and capital budgeting and overseas capital budgeting. Give the heading. Inflation and capital budgeting. Small aspects only, but unique aspects are advanced issues which we may not have studied in the IPCC level. Okay, inflation and capital budgeting. Okay, please. Shh. Stop talking. Capital budgeting is an exercise companies undertake to select or reject projects. Right or not? They calculate NPV. Positive means accept, negative means what? Reject. Positive NPV maximizes wealth, negative NPV erodes the wealth. So positive NPV project should be accepted, negative should be rejected. Can I start now? How you calculate NPV? There are two stages. You estimate cash flows. What is the investment to be made? First year, second year, third year, fourth year. What are all the various profits or cash flows a product is going to generate? So you do the estimation of cash flows. Once the cash flows are estimated, next issue is what? You identify a discount rate, discount the cash flow and calculate the NPV. Am I right or not? Now, when I estimate cash flows, the two estimations which are involved. One is estimation of volume. One is what? Estimation of volume. And second is estimation of the cost associated with the volume. Respond. Are you following? What simple example I say? For example, I predict that I am going to sell 10,000 units in first year, 20,000 units in second year and 5,000 units in third year. A project having a demand of 10,000, 20,000, 5,000 in first year, second year and then what? Third year. My question is, all these three numbers are guaranteed numbers, are estimation. First is I have to estimate my demand or volume for future. Yes or no? Is the volume estimation. Yes or no? Now, for this volume, I multiply by selling price, get my revenue. Whatever. For this volume, I multiply the number of kgs required into cost per kg, I get what? Material cost. Hours required, labor, I give what? Labor cost. I estimate fixed cost. I also estimate the cost component for all this volume. Okay. This is the estimation process in capital budgeting. Can I go to the next step or not? Now, first of all, capital budgeting is all about estimation. The estimation is done for two things. One is volume estimated and number two is what? The cost estimated for the given volume. Discounted to find out what? NPV. Accept positive, negative, reject. Up to this now. When I estimate the future cash flows, I have two options. Estimate the future cash flows at the current purchasing power. Are you following what I am saying? Are you following? Estimate the future cash flows at current purchasing power or estimate the future cash flows at the respective year's estimated purchasing power. Respond. Are you following what I am saying? Now, see, again I say, no disturbance I want in the class. See, every time when I complete something, start new thing, you relax and then what? Start. You make me repeat 2 or 3 times unnecessarily due to your lack of concentration. Now, Every word I speak, you will be intently listening because I don't speak unnecessary words like you gossiping. I am not speaking with anybody, I am speaking only subject. In that case, listen intently. Main problem, most of the times you are not understanding is you are switching off your mind. Then connect for any number, okay. Suddenly you want to start writing. What you understand, you understand. What you cannot find difficult, what do? You leave it. You don't make an effort to what? Understand. Can I proceed once again? Now, see. Future cash flows has to be estimated or not? I can estimate the future cash flow in today's purchasing power or in what? Respective year's purchasing power. Everybody following? I'll give a simple example here. Now, first year, I expect to sell 10,000 units of a product. Every unit requires 2 kgs of raw material. How many kg requires? 20,000 kg required. This is estimation. The 20,000 kg, if I multiply by the price of the raw material today, I am estimating the cash flow at the today's purchasing power. Yes or no? Suppose the price of the raw material today is 10 rupees per kg. How much per kg? 10 rupees per kg. The 20,000 kgs into 10 gives how much rupees here? 2 lakh. Is the estimation only. But in what purchasing power? Today's purchasing power. Yes or no? Or another way to estimate is, today the raw material is 10 per kg. I expect an inflation of 10%. How much percentage? 10%. So I feel that at the end of the first year, I'll be purchasing how much rupees? 11 rupees. Now, in that case, still I am doing estimation, but not at today's purchasing power. What? Respective purchasing power where I estimate the inflation also. Everybody, yes or no? So there are two types of cash flows. Cash flow estimated at what? Today's purchasing power. Cash flow estimated at what? The respective year's purchasing power. Yes or no? The first cash flow is without inflation and second cash flow is what? Loaded with inflation. Everybody, are you following? That means there are two types of cash flows. How many types of cash flows here? Two types of cash flows. One is money cash flow. Another is real cash flow. What do we have cash flows here? Money cash flows. And then what? Real cash flows. Money cash flows are the estimated cash flows loaded with what? Inflation. Real cash flows are also what? Estimated cash flows loaded with the what? No inflation. Everybody saw no? Now, this is with inflation, this is what? Without inflation. So, this is a cash flow estimated along with inflation. Cash flow estimated what? Without inflation are called as real cash flow and what? Money cash flow. Respond. Are you following or not? Okay. Now, I'll come back to this once again. Okay, leave this point at present. I'll discuss the next point and then come back to the first point once again to link it. Can I proceed? Now, next is interest rate. Okay. Suppose a bank or the say return is 12%, interest rate is 12%. Interest rates are given to compensate two things. What two things here? Inflation and then risk. IPCC study or not? Now, why should I deposit today 1 lakh rupees here? Why should bank give me after 1 year 1,10,000 rupees here? I gave the money, same money should be returned back or not? I put a chapel in outside a temple here. 2 chapels I put. When I come back, I will ask 3 chapels. They give only what? Same 2 chapels. This one, what I give, they should return. I give the bank 1 lakh. At the end of the first year, I want the bank to give me what? 1,10,000. Why is 10,000 extra? Tell me. For 2 things, to compensate inflation, to compensate my risk, yes or no? If I deposit the 1 lakh with an Indian bank, I will ask how much percent? 10%. If I deposit in an RBF, I ask what? 18%. The interest rate also changes because of risk premium. Respond, yes or no? In that case, the interest rates are offered to beat 2 things or compensate 2 things. One is what? Inflation. Another is what? Risk. Ennappa, right or not? What I am saying? Now, in that case, interest rate is there to compensate what? 2 things. Inflation and what? Risk. Okay. See. There are 3 percentage or 3 rates. Money rate, real rate, inflation rate. What 3 rates here? Money rate, real rate, inflation rate. Just in few minutes, we'll have everything in clarity. Just I'm introducing different terms. Money rate, real rate, and then what? Inflation rate. Inflation rate is the rate of inflation. Is the rate of what? Inflation. Okay. Now, very simple. This is not correct, but to understand normally, say there is a risk-free rate. RBI bond is issued. Reserve Bank of India bond is what? Issued. They issue a bond for example, 6%. What percentage? 6%. Why? Because RBI deposit is risk-free. In that case, why should I ask 6%? Because I have to get compensation for what? Inflation. So risk-free rate can be mostly understood to be compensation for what? Inflation. It is not true. I'll discuss it later. Just primitively understand like this. Respond. Are you follow what I'm saying? So there's a rate called as what? Inflation rate. Okay. Now, real rate is a rate to compensate risk alone. Is a rate to compensate what? Risk alone. It will not compensate for what? Inflation. Money rate compensates for inflation as well as what? Risk. So money rate compensates for inflation and risk. Real rate compensates only for what? Risk. Does not compensate for what? Inflation. And this is the inflation rate. Everybody, are you following what I'm saying? So these are the three types of what? Interest rates. Now, I discussed two types of cash flows and what? Three types of percentages. Now, let us link them to have an overall idea what we are trying to discuss now. Can I proceed or not? Now, first, before I proceed, what are two types of cash flows? Money cash flow, real cash flow. Money cash flow is a cash flow loaded with what? Inflation as well as risk. Real cash flow does not have what? Inflation. That's not risk. It is having risk because I'm estimating 10,000 units first year, 20,000 second year, 5,000 what? Third year. The volume which I estimate may prove to be wrong based on businesses. Yes or no? The word risk generally goes from what? Volume only, or the inefficiency, etc. So this is representing what? Risk alone, but does not have what? Inflation. So money cash flow is loaded with inflation as well as what? Risk. It is having risk because next year 10,000 may happen, may not happen. It is also having what? Inflation because 10 rupees are what as what? 11 rupees. It is having inflation inside it as well as what? Risk inside it. Real cash flow is current purchasing power, yes or no? But it is estimated current purchasing power, still it is estimate only. Real cash flows are actually estimates are estimate. I estimate volume, but multiply by what? Current prices. So volume is uncertain. The current price is what? Without inflation. It is loaded with risk, but not loaded with what? Inflation. Now, that three interest rate, money rate, that money rate will be obviously higher than what? Real rate. It compensates for risk as well as what? Inflation. Real rate compensates only for what? Risk. And inflation is obviously the rate of inflation which we estimate. Everybody follow what I am saying? Now, these are the three, two issues we have discussed. Can you link the two or not? Now, look at the third discussion. Tell me, how many types of cash flows are there? How many types of cash flows are there here? I have three types of cash flows. Discounted cash flow, real cash flow, money cash flow. What is discounted cash flow? Real cash flow, and then what? Money cash flow. Everybody following or not? Now, money cash flow is loaded with inflation and risk. Okay. If I take inflation out, I get what? Real cash flow loaded only with what? Risk and does not have what? Inflation. When I take risk out, the discounted cash flow is having what? No inflation, no risk. Because when I discount the cash flow, by discount rate, I take the risk also as well as what? Inflation also. Cash flow sans risk, sans inflation. Or cash flow without risk, without inflation. Cash flow without inflation, with risk. Cash flow what? With risk, with inflation. Everybody, are you following or not? No. Very simple. Money cash flow, I discount using inflation rate. Discount rate is 1 by 1 plus r power n. So 1 by 1 plus IR means what? Inflation rate. When discount the money cash flow with what? Inflation. Whenever it discounts something, it is taken out. When this is going to be what? Taken out. When discount the money cash flow with inflation rate, I take what out? Inflation out. What if it is only what? Risk. It becomes what cash flow? Real cash flow. The real cash flow, if I discount using what rate? Real rate. And what rate here? Real rate. It compensates for risk or not. So when I discount the real cash flow with what? Risk premium or what? Real rate. What stays is only what? Cash flow without risk. Yes or no? So by discounting at inflation rate, the money cash flow, the inflation gone. By discounting at what? Real rate, the risk gone. The discounted cash flow is without what? Risk or as well as what? Inflation. This is like a passenger train. Like what? Passenger train. First stop and then what? Second stop. We have point to point train. Yes or no? In that case, the money can be brought to what? Discount. Straight away by discounting at what? Money rate. Because we discount at money rate, I discount more for inflation as well as what? The rest. It brings to discounted cash flow. Everybody, right or not? So, one is discounting first at inflation rate and then again at what? Real rate is as good as what? Discounting the money cash flow at what? The money rate. Respond. Are you all following what I am saying? Okay. In the clarity, now, next. From this, I can say find out another small rule. The rule is that if the question gives you money cash flow, discount using what rate? Money rate. If the question gives you real cash flow, discount using what? Real rate. You cannot discount real cash using what? Money rate, because it's already discounted for inflation in the question. Right, what I am saying? In a case, real cash flow should be discounted at real rate of interest. Money cash flow using what? The money rate of interest. Yes or no? No. The money cash flow can be discounted even twice. First using what? Inflation. And then also using what? Real rate. Is another corollary. Everybody, are you following what I am saying? Okay. From this, let us try to establish the relationship between the three interest rates. What three interest rate? Money rate, real rate, inflation rate. The relationship is very simple. 1 by 1 plus money rate. To the power n is always there. N is going to get what? Cancel. 1 by 1 plus money rate. He is discounting as money rate. No, it's nothing but 1 by 1 plus real rate into 1 by 1 plus inflation. Don't add plus, the word plus now or, okay. I discount once and I discount what? Once. Always, wherever you use the word and, it should be only what? Multiplication. In the right or not? Now, in that case, 1 by 1 plus real rate into what? 1 by 1 plus inflation rate is going to give you what? 1 by 1 plus money rate. Understood discounting or not? Now, in the inverse can be taken up, yes or no? In a 1 by can also be what? Total. So I can say 1 plus money rate is equal to what? 1 plus real rate into 1 plus inflation rate. Other words, money rate is equal to what? 1 plus real rate into 1 plus inflation rate. Minus 1 is a very famous formula. Everybody yes or no? So money rate is equal to what? 1 plus real rate into 1 plus inflation rate minus 1. Suppose somebody asks us, find out real rate. Money rate, inflation rate given. How to find out what? Real rate. What is real rate? Yeah. 1 plus money rate by 1 plus inflation rate minus 1. What is inflation rate? 1 plus money rate divided by 1 plus real rate minus 1. Everybody have the clarity or not? Now, this is an introduction to this area called as inflation and capital budgeting. It will help us in understanding overseas capital budgeting much more better, where international fixtures effect will be discussed in the IFM. Everybody, are you following or not? Now, so this is regarding the introduction to the area inflation and capital budgeting. Everybody absolutely clear or not? Let's have a small notes in this regard and then start with the problems. Okay, inflation and capital budgeting, please. Inflation and capital budgeting. Point number 1. Capital budgeting exercise involves estimation of cash flows. Capital budgeting exercise involves estimation of cash flows, comma, selection of discount rate. Capital budgeting exercise involves estimation of cash flows, selection of discount rate, and calculation of NPV. Selection of discount rate and calculation of NPV. Last, no need to tell, it will be selection of what? Projects, that I can leave it, and calculation of NPV. Point number 1 or 2? 2. The cash flows, point number 2, right? The cash flows can be estimated in 2 ways. The cash flows can be estimated in 2 ways. Branch it into 2. First branch, right? Cash flows, future cash flows estimated at First branch, right? Future cash flows estimated at current purchasing power. Future cash flows estimated at current purchasing power. Second branch, future cash flows estimated at. Second branch, future cash flows estimated at the respective years purchasing power. Future cash flows estimated at the respective years purchasing power. Future cash flows estimated at the respective years purchasing power. The respective years purchasing power. I think you are all comfortable or not? No. First branch, put a down and write called, tell me they are called what cash flow? Money cash flow. Called money cash flow or nominal cash flow. Some books use the word nominal cash flow also. We can have the other name also. Money cash flow or nominal cash flow. Called money cash flow or nominal cash flow. Second branch, write real cash flow. Second branch, write real cash flow. GDP in economics I studied now. There are two types of GDP. One is adjusted for inflation without adjusting for what? Inflation. I think you all heard it or not. So, real price index as well as what is the gross price index. Right or not? Same. This is also what? Same concept only. Can I proceed? Now, next point number 2 or 3? 3. Point number 3. There are 3 types of rates. There are 3 types of rates. I don't want to use the interest rates because inflation rate is not interest rate. Hence I use the word simply rates. There are 3 types of rates. Branch it into 3. Branch it into 3. Tell me what are the 3 types of rates here? Money rate. First rate is money rate or nominal rate. Money rate or nominal rate of interest. Money rate or nominal rate of interest. Money rate or nominal rate of interest. We can say money rate of interest or nominal rate of interest. You should be doing that. Yes or no? Now, second branch, real rate of interest. Second branch, real rate of interest. Third branch is inflation rate. Don't say inflation rate of interest. Third is what? Inflation rate. Third branch is inflation rate. Please. Money rate, put a down and write, compensates for. Money rate compensates for. Please fill in the blanks. What and what? Inflation and risk. Money rate compensates for inflation and risk. Real rate compensates for inflation. So, they compensates for risk. That's what I meant. Real rate compensates for risk. Real rate compensates for risk. No need anything. Inflation, you know, it is going to be for what? Inflation. Leave it. Compensates for risk. Everybody following or not? Next. Point number 3 or 4? 4. Point number 4. There are 3 types of cash flows. Point number 4. There are 3 types of cash flows. Branch it into 3. What are 3 types? Tell me. Money cash flow. First branch, money cash flow. Second branch is what? Real cash flow. Third is discounted cash flow. The 3 types of cash flows: money cash flow, real cash flow, discounted cash flow. Go to money cash flow, put a down your mark and write. Tell me money cash flow, what it does? Loaded with. Is loaded with risk and inflation. Risk because it is an estimated cash flow. Inflation because what? It is done at the respective year purchasing power. Yes or no? So loaded with inflation and risk. Loaded with inflation and risk. Real cash flow, right? Loaded only with risk. Can I estimating at the current year purchasing power or not? Loaded only with risk. Discounted cash flow, no risk, no inflation. Already discounted na, no risk, no inflation. No risk, no inflation. No risk and no inflation. Can I proceed or not? Next. Point number 5. Point number 5. Write the three cash flows like this: discounted cash flow, real cash flow, money cash flow. Discounted cash flow, real cash flow, money cash flow. First, money cash flow, link it to real cash flow. Money cash flow, link it to real cash flow. Please tell me, money cash flow is with inflation risk, yes or no? How to take inflation now? Discount using inflation. 1 by inflation rate. Now, 1 year na 1 plus IR power 1. 2 years means what? 1 plus IR power 2, and so on, that you can understand or not? So, it is 1 by 1 plus inflation rate. Real cash flow and discounted cash flow link it. Discounted what? 1 by 1 plus real rate. 1 by 1 plus real rate. Because already inflation is out, I have discount only what? Risk. 1 by 1 plus real rate. Money cash flow and discounted cash flow link it straight away. We should take what? 1 by 1 plus money rate. 1 by 1 plus money rate. 1 by 1 plus money rate. I hope everybody following or not? Now, write same point, write as a paragraph. By discounting MCF, MCF means what? Money cash flow. By discounting money cash flow by inflation rate, by discounting money cash flow by inflation rate, inflation is taken out. By discounting money cash flow with inflation rate, inflation is taken out. What remains is only risk. Inflation is taken out. What remains is only risk. Hence it becomes what cash flow? Real cash flow. Hence it becomes real cash flow. Hence it becomes real cash flow. Full stop. Continue. By discounting real cash flow with real rate, by discounting real cash flow with real rate, by discounting real cash flow with real rate, risk also is taken out. Risk also is taken out. Risk also is taken out. And the cash flow now becomes, what cash flow? Discounted cash flow. And the cash flow now becomes discounted cash flow. And inflation taken out, it became real. Risk taken out became what? Discounted cash flow. Alternatively, when MCF is discounted with money rate, you all know that money rate components are both, yes or no? When MCF is discounted at money rate, both inflation and risk is taken out. Both inflation and risk is taken out, resulting in discounted cash flow. Both inflation and risk is taken out, resulting in discounted cash flow. I hope everybody following or not, resulting in discounted cash flow. Last point, point number 6. 1 by 1 plus money rate is equal to 1 by 1 plus money rate is equal to, from this you know, discounting this is equal to what? 1 by 1 plus real rate into 1 by 1 plus inflation rate. 1 by 1 plus money rate is equal to 1 by 1 plus real rate into 1 by 1 plus inflation rate. 1 plus money rate is equal to 1 plus money rate is equal to 1 plus real rate into 1 plus inflation rate. 1 plus money rate is equal to 1 plus real rate into 1 plus inflation rate. Money rate is equal to 1 plus real rate into 1 plus inflation rate minus 1. Money rate is equal to 1 plus real rate into 1 plus inflation rate minus 1. Other two we can derive on your own. Yes or no? Now, this is a relation between the three rates which are given. Can we start or not? Now, let's do one problem in this inflation and capital budgeting. This will act as a basis for discussing the overseas capital budgeting in the next stage. Okay, now please. Question number 17. Question number 17. Take question number 17. Don't talk, please. Shh. PQR company. Shh. PQR company is examining an investment proposal. Shh. Requiring an initial outflow of 8 lakhs. An expected inflow in real terms, today's purchasing power of rupees 2,80,000 per year for next 4 years. The company's out-of-pocket monetary cost of capital is 9%. Monetary cost of capital means what? Money rate. And inflation rate is 3.2%. over the next 4 years. Compute the company's real cost of capital. What is the present value of cash inflows if the real cost of capital is taken into consideration? Compute the nominal cash inflows from the real cash inflows and then calculate the present value on the basis of nominal cash inflows. That's a question. Okay. Now, please read the question quickly before you start with the solution. You try to understand the question on your own before you start with the solution. Please make an effort to read every time I give you time to read a question. Shall I start or not? Now, what is the amount to be invested in the project? 8 lakhs. That is year 0 cash flow. You need not worry, real money, etc. is always what? Discounted. Now today cash flow is certain. Also at what? Today's purchasing power. You need not worry about the interest rate. It is not. No. But the estimations they are made. How many years life the project is having? 4 years. So estimated every year the project to be giving how much cash flow? 2,80,000 on current purchasing power, respective purchasing power. Correct part solliya. Please. Shh. Every year the project gives me 2,80,000, 2,80,000, 2,80,000, 2,80,000. How many years? Yeah, 4 years. This estimation is done at current purchasing power, respective purchasing power. How current purchasing power? Real cash flow. The cash flow given are what? Real cash flows. Now, can I discount this 2,80,000 real cash flow using the 9% cost of capital given? No. Why can't I discount? Because this 9% is loaded with inflation and what? Rest. Already the cash flow is without inflation. I have discount only for what? Rest. So this 2,80,000 should not be discounted using money rate, but discounted using what? Real rate. So the first step is to calculate what? Real rate and then discount it to find out the NPV. First question. Yes or no? Next. Another question is, you convert this cash flow into money cash flow. Convert the cash flow into what cash flow? Money cash flow. How a real cash flow can be converted to money cash flow? By compounding using inflation rate. Yes or no? In today's purchasing power, if I receive a 10,000 rupees income, inflation 10%, what is the income in the next year? 11,000. Respond yes or no. So compound the cash flow using inflation rate and find out the money cash flow. That you should discount at what rate? 9%. Both will give you the same NPV. Everybody following what I am saying? Any question? Now, the question has been asked 3 questions here. Then what is the first question? Calculate the real cost of capital. Second is what? Calculate the present value means what? Net present value. And third is what? Compute nominal cash flow means what? Money cash flow. And recalculate the NPV. Everybody following or not? Now, can we do it together some or not? Now, first of all, I want the formula. Tell and then write. 1 plus money rate is equal to what? 1 plus real rate into 1 plus inflation rate. I want real rate. Tell me the formula for real rate. Real rate is equal to what? 1 plus money rate divided by 1 plus inflation rate minus 1. Gives you what rate? Real rate. Everybody yes or no? That's the first question. Can I start up? Now, write down. Step 1. Calculation of real rate of interest. Please. Step 1. Calculation of real rate of interest. Calculation of real rate of interest. Underline that. Real rate is equal to, here RR is equal to, real rate is equal to formula 1 plus MR divided by 1 plus money rate divided by 1 plus inflation rate. 1 plus MR divided by 1 plus IR minus 1. 1 plus MR divided by 1 plus IR minus 1. Minus 1 is separate. Okay, 1 plus MR by 1 plus IR, 1 block, minus 1, 1. Can I proceed or not? Now, substitute. Real rate is equal to 1.09, correct? 1.09 divided by 1.032. 1.09, money rate is 9%, na? 1.09 divided by inflation is 3.2, 1.032 minus 1. 1.09 divided by 1.032 minus 1. What is the rate of interest? 5.62%. The real rate is 5.62%. This 5.62% is present there to compensate my what? Risk. And this 9% is to compensate by what? Risk. As well as what? Inflation. Where the inflation is 3.2%. I think I have the clarity or not? Now. Can I proceed next stage? Now. Step 2. Calculation of NPV. Step 2. Calculation of NPV. Calculation of NPV. Following columns. Year cash flow, present value factor at 5.62%, discounted cash flow. Why I am telling I am discounting at 5.62%? Tell me. The cash flows are real cash flow. I should obviously discount at what rate? Real rate. Okay. Year cash flow, PVF at 5.62% and then discounted cash flow. Can I start or not? Now. Single cash flow, multiple even annuity or perpetuity? Annuity. 1 to 4 years. 1 to 4 years. What annuity cash flow? 2,80,000. 1 to 4 years, 2,80,000. Take the calculator. Don't watch like a movie. Do it and tell me. 1 by 1.0562 is equal to 4 times plus grand total. What is the number? 3.4958 is equal to 3.4958. 3.4958. 3.4955, yeah. Okay, some number. Some number here, 3.4955 or 582, just round it off. Can I proceed? Now, 2,18,000 to 3.49 something is going to give me 9,78,824. Huh? Have it, yeah. Okay, copy. That's last decimal. Leave it. 9,78,824. Have it. That's third umpire. Okay, 9,78,824. Rounding out difference. Amount, tell me the amount. 9,78,000. How many days? 732. I had as what? Stop. You said 9,78,000, 732. Correct? I wrote as what? 824. Due to that, less than 100 rupees will exit the project. Right now. This is unnecessary dragging the class here. Accept it. Okay, now. What do you want to write? 9,78,730 or 824. Write it. Any written out now. Next. Totally same. Discounted cash inflow, please. Discounted cash inflow 978, 732. You can write 978, 732. Or 978, 824. Anything you can write. Okay. Follow me. Can I proceed now? Minus discounted outflow. Minus discounted outflow. How much are you investing here? 8 lakhs. Next place 8 lakhs. Tell me NP is positive or negative? Positive. Or positive NP 1,78,824 or 1,78,732. You know number here. 1,78,824. Please. Shh. Don't create more confusion. Can I proceed? 178,824. Stop writing. Are you all following or not? Now. What is the moral of the story? Real cash flow should be discounted at the real rate of return which we calculated. Can I proceed or not? No. This 2,80,000 rupees cash flow is without inflation. Yes or no? If a load inflation, the cash flow will increase or decrease? Increase. Now I am going to convert the real cash flow into money cash flow and then discount it at what percent? 9%. I will get the almost the same answer. Every day due to rounding of number only, some difference may be there. Are you following or not? Now, write down next. Step 2 or step 3? Step 3. Calculation of NPV. Calculation of NPV by converting the cash flows into money cash flows. Calculation of NPV by converting the cash flows into money cash flows. Question the username what? Nominal. Both are same. Okay. Calculation of NPV by converting the cash flows into money cash flow and discounting at money rate. Calculation of NPV by converting the cash flows into money cash flow and discounting at money rate. Can we start now? Here cash flow, present value factor at 9%, discounted cash flow. Here cash flow, PVF at 9% and discounted cash flow. Can we start now? First, year 1. 2,80,000 rupees first year cash flow is in first year purchasing power, today's purchasing power, today's purchasing power. At the end of the first year, the prices are going to be same. It's going to increase. Both my selling price as well as my what? Cost. Both are going to experience what? Increase. It increases by how much percent? 3.2%. That means year 1 money cash flow is 2,80,000 into what? 1.032. Ennappa, write or not? So write down 2,80,000 into 1.032. 2,80,000 into 1.032. 2,80,000 is in today's prices. The price is going to increase by 3.2%. First year in it should be how much? 2,80,000 into 1.032. It's going to how much? 2,88,960. 288,960. 1 divided by 1.09 if we put, I get the present value factor as 0.9174. 0.9174. Discounted cash flow 265,092. My decision final. Okay. 265,092. Can I proceed now? 265,092. Can I proceed now? Next. Year 2. So, today the purchasing power is 2,80,000. It compounds how many times, sir? 2 times. 2-year inflation, so no. It's going to be what? 2,80,000 into 1.032 power 2. 2,80,000 into 1.032 power 2. Is it how much? 2,98,207. And it increases to 288. Once again what? Increases by another 3.2%, becomes what? 2,98,207. What the present value factor for second year? 0.8417. PVF for second year is 0.8417. The discounted cash flow is 2,51,000. 2,51,000. Third year, everybody tell me what is the cash flow? 2,80,000 into 1.032 the power 3. 2,80,000 into 1.032 power 3. 3,07,749. 3,07,749. PV factor at 9% is 0.7722. 0.7722, 2,37,643. 2,37,643. 237,643. Year 4. So, year 4, what is the number? 2,80,000, 1.032 power 4. 3,17,597. 3,17,597. PV factor for the fourth year at 9%, 0.7084. Number 2,24,985. 2,24,985. If I total it, I'll be getting a discounted cash inflow. What percentage of inflow? What discounted cash inflow total? 9,78,720. 9,78,720. Respond yes or no? Minus present value of outflow. Minus present value of outflow. What is discounted cash outflow? 8 lakhs. What is the net present value? 1,78,720. 1,78,720. It is almost similar to this now. It is 1,78,824. I think you got a 732 much more closer now. So it is almost same. Whether you use the money cash flow or real cash flow, the decision should not change. NPV should not what change. The wealth should not change due to the use of the cash flows. Everybody, are you following or not? With this, we complete the solution to question number 17. Okay. 18th question is not such a great question involving inflation. And RTB question included. I'll give the solution later. Nothing great to discuss in the classroom. Now we can move on to the next area called as what? Overseas capital budgeting. Give the heading. Don't shout here. Now only 8:45. Solidly half an hour left. Write down. Overseas capital budgeting. Overseas capital budgeting. Very important concept asked number of times in the examination. Okay, overseas capital budgeting. Please. Shh. Now, stop talking. See, we discuss in dividend policy chapter itself NPVN share valuation concept. Yeah. Yes or no? See, you are not understanding the importance of every class or even value of discussion. You are not understanding here. You are just devaluing it. That's why so much insincerity comes. Every time you keep talking, understand that simply what you are discussing, all these issues is even level 2 CFA covered here. Every aspect what you discuss mean what? Full coverage of the syllabus. And number of questions are being asked in our institute examination also. Are you following or not? Now, these issues, you will not get so much clarity in textbooks. I can again say you don't get so much clarity in what? Textbooks. Study material will never get what? Any clarity. You will be only getting confusion. I am not criticizing. I am saying the real position. And even good written textbooks, they won't explain all things in what? So much detail. Nothing can substitute for classroom discussion. Understand that. Value the time spent here. Try to get the full benefit out of it. Now, It is like for a LKG student, take an engineering portion. You know what I'm saying? That is, you should mature to that particular grade, right? Did you all understand or not? You should what? Come out of CPT mindset when you come to what? IPCC. Come out of IPCC when you come to what? FIANL. Try to learn subject more deeply and also have more contemplation and more be disciplined. Can I see it now? That I expect from the class. Otherwise, no motivation to share. A person, very simple, a person is doing a music concert, music concert, okay. He is keep on singing, others keep on talking themselves. He will not sing well, he will not sing what well. In marriage and all, they do music concert or not. So they will be keep on singing, yeah. He will be eating and talking, laughing, going. Yes or no? I don't want the class to be like a marriage concert, it will be like a Sabha concert, yes or no? The Lok Sabha is not a concert, yeah. That's a rock show. No, please. If you go to Sabha and all, what happens? Yeah, they'll be listening what? Intently, without any disturbance. In your terms, there are two stadiums, okay, cricket stadium, tennis match, okay. Now, I always said, cricket match, player will be playing, they will be shouting, okay. We don't see any correlation. Tennis match, they will talk, okay. Between 2 points, they will talk. Once the point starts, they'll keep quiet. Yes or no? That too in Wimbledon, immediately, that is a real discipline. There'll be, if you see that TV also, there'll be a little bit noise when the players are settling for what? Next point. Once the serve begins to happen, pin drop silence. It's going to be what? Pin drop silence. Ball sound can be heard. Kohli shouting also nobody hears. Yes or no? Now, I have microphone to hear. I tell what I'm saying now. Classroom should be like a tennis match, not like what a cricket match. Even though our national game may be cricket, almost hockey we forgot, maybe what a cricket. So too our listening also. We lost all patience gone. Okay. All this time which I am speaking is going to be compensated today itself. Can I say it? No. Then keep quiet. Can I say it? No, please. Shh. See, NPV, he is having an impact on wealth as well as share price. Very simple. Company's current market price of share is 30 rupees. How much is it? 30 rupees. It is having, for example, 10 lakh shares. How many shares here? 10 lakh shares. That means the value of the company today is 10 lakh shares into what? 30. It is a 3 crore rupees company. Yes or no? The value of the company is 3 crores. Are you following what I am saying? Now, what happens is, company has a new project. Has what? A new project. For it raises new money and also what? Invest. The new project is having an NPV. Is having what? NPV of suppose 50 lakhs. How much is here? 50 lakhs. In that case, the company will be 3 crore company, more than 3 crores, more than 3 crore, because the positive NPV increases what? The wealth further. We discuss in Modica and Miller approach, etc., etc. Yes or no? Always new project, new NPV. NPV may be earned later, but the amount is factored what? Today itself in fixing the share price. So no, now the market price of the share is not 3 crore divided by 10 lakh. It becomes what? 3 crore 50 lakhs divided by what? 10 lakh. Suddenly from 30 becomes what? 35 rupees, the share price. Are you following what I'm saying? So the share price going up and down, all based on future projected earnings, present value, which is what we call as NPV of the projects. Right or not? So project NPV has a great impact on the share valuation. Yes or no? Ultimately, anything we are doing is only to increase the price of the share. Yes or no? Accept those projects giving you the positive NPV as it increases the share price, and don't accept those giving what? Negative NPV as it pulls down the share price. Do you understand the context of NPV discussion or not? Yes. NPV is the heart of the subject where it affects the share valuation directly. Everybody following? Yes, now, see. There's a company in India. It is now going to start, or it is evaluating a project, not in India, but in US. It's going to evaluate a project in what? US. They want to open a new project in US. Okay, answer my question. New project in US, I want to calculate the NPV of the project. I want to calculate what? NPV of the project. The cash flows of those projects will be in rupees or dollars. Because when you do a business in another country, the cash flows will be naturally what? The currency of that particular country only. Any US project done by an Indian company will be having cash flows only in what? Dollars. I can find the NPV in dollars, but no use because with NPV in dollars, I cannot see the impact on share price because my share is trading in Bombay Stock Exchange in rupees. My share is trading in rupees, but the project NPV is in what? Dollars. How the dollar NPV affects what? Rupee share price? You cannot link it unless we convert the NPV into rupees. Yes or no? So that is what we can what? Overseas capital budgeting, where how the foreign projects NPV should be reported in what? Rupee terms is what a subject matter of discussion. Everybody, yes or no? Decision is very simple. Dollar NPV positive now, rupee NPV also generally will be what? Positive, unless interest rates and exchanges are what? So bad. But generally it will be not great in acceptance or rejection. But when I want to know the impact, I should know the impact in what? Rupee term. So all foreign currency NPV should be converted into what? Local currency. How to do that is the issue under this area called as what? Overseas capital budgeting. Everybody following or not? There are two methods. There are how many methods here? Two methods. One is home currency approach and another is foreign currency approach. So what are the two methods? Home currency approach and then what? Foreign currency approach. Both approaches are used to calculate the NPV in home currency. To calculate NPV in what? Home currency. Now, let us see first home currency approach. Let's see first what approach here? Home currency approach. Very simple. Listen to the steps, then we can just go for the solution. Okay. Now, I have a project having cash flows in dollars. All dollar cash flow first converted into what? Rupee cash flow. Dollar cash flow converted into what? Rupee cash flow. Using what? Exchange rate. Convert all the dollar cash flow into what? Rupee cash flow. Using what? Exchange rate. Today dollar cash flow. Today year zero investment $30,000 convert into what? Rupees. Using what rate? Spot rate. Today's investment convert using what rate? Spot rate. First year, second year, third year, fourth year, fifth year. 5 years dollar inflow is going to be there or not? That should be converted into rupee cash flow using what rate? Using what rate? Forward rate. Exactly using what rate? Forward rate. But not that project started, can I go to the bank and enter into forward rate? So when I say forward rate, is an estimated forward rate as per IRPT. As per what theory? Interest rate parity theory. Respond or not? No. For example, $1 is 50 rupees today. Example, simple calculation. $1 is how much? 50 rupees. Suppose India interest rate 10%, US how much percent? 5%. So how I calculate IRPT? $1 into 1.05 is equal to 50 into 1.10. You calculate 1 year forward or not? So using IRPT forward rates for all the 5 years, convert the dollar cash flows into what? Rupee cash flows. Respond is or no? So now I have all the cash flows in what? Rupees. Discounted home currency discount rate. What rate here? Home currency discount rate. If the project was done in India, it will be having a cost of capital or not? So discount is in the home currency cost of capital. I will get in the local currency NPV. Everybody respond. Number one. Are you following or not? Is a home currency approach. Can I say? No. Other approach is what? Foreign currency. It is very simple. I have dollar outflows and inflows or not? Discount the dollar cash flows using the dollar cost of capital. Are you following what I am saying? If I do the product in US, it is having cost of capital or not? So discount the cash flow using what? Dollar cost of capital. I will be getting the NPV in dollar. Yes or no? NPV is net future value and net present value. Present value. It is in year zero terms or not? Convert that using what? Spot rate. I will be getting the home currency NPV. Are you following what I am saying? Both will be same. Both should be same. Are you following? Are you following what I am discussing now? These are the two types of approaches to calculate the home currency NPV. Tell me, are you having the clarity here? Now, tell number one. First, home currency approach. Tell me the step. First, convert what? All foreign currency cash flows into local currency. Spot cash flows using what? Spot rate. Future cash flows using what? IRPT forward. Point number one. Over or not? Next. Discount the home currency cash flow using what cost of capital? Local cost of capital, domestic cost of capital. What I get is the home currency NPV. Foreign currency approach. Discount all the foreign currency cash flow using what? Foreign currency cost of capital. That you convert it into what? Calculate the NPV. Convert it into what? Local currency using what? Spot rate. I'll be getting the same answer. Yes or no? But the interesting aspect here is establishing relationship between home currency cost of capital and then what? Foreign currency cost of capital is what we can say international features effect. Are you following what I'm saying? How that should be established? We'll be discussing in the same plank as money rate, real rate and then what? Inflation rate. That will be the second stage of discussion in this particular concept. Everybody, are you following or not? Now. So now we can quickly in 5 minutes do one problem regarding this home currency and foreign currency NPV. Please. We'll have the detailed discussion in the next class. Can we start or not now? Every class, don't delay. Can I start or not? Now, please. Quickly take question number 5. Stop talking. Take question number 5. An American firm is evaluating an investment proposal in Holland. Please don't talk. The project cost is 1.5 million NLG. NLG means Netherlands guilders. 1.5 million, 1 million is 10 lakhs. 1.5 million is what? 15 lakhs. Okay. The interest rate in Holland and USA are respectively 6%, 5%. Is the risk-free rate of interest in Holland and then what? USA. The spot rate 1 NLG is equal to $0.5. Cost of capital in USA is 16% and NLG discount rate is 17.1%. Very simple. If I do the project in NLG, in Holland, what is the cost of capital? 17.1%. Same project if I do in what? USA, the cost is how much percent? 16%. Everybody yes or no? Now, these two are the cost of capital. The first two given 6% or what? 5%. If I invest in a central bank, like a reserve bank, if I invest in what? Central bank of NLG or Holland, I'll be getting how much interest? 5%. In US federal bank, if I invest, what is the interest rate? 6%. It is a country's interest rate given, risk-free rate. Everybody following or not? Now, alternatively, leave it. Can I proceed? Now, cash flows of 5 years project are as follows. Cash flows are given in thousands of rupees, 400,000, 450, etc., etc. Evaluate under both approaches. What are both approaches? Home currency, foreign currency, and advise whether the project should be taken up or not is the issue. We'll do the solution together. Everybody, can we start or not? Now, just quickly revise the sum before I start with the solution. Okay. Tell me, what is the home currency? What is the home currency? Dollar. What is the foreign currency? NLG. I want to make the investment in what? Netherlands. My investment is overseas investment. Respond yes or no? I am going to invest how many NLGs? 1.5 million NLGs or 15 lakh NLGs, and the cash flows are also given in what? NLGs. If I invest in US, the cost of capital is 16. Same part done in Holland, the cost of capital is 17.1. That's a link between 16 and what? 17.1. We'll discuss in the next class. Can I proceed? I want to answer the question now. Calculate the NPV in NLG or dollars or dollar. Because the company is in what? US. They want a dollar NPV to know the impact on their dollar share price. Everybody, are you following what I'm saying? Now, can you start doing the solution together? Now, the IRPT interest given US, what is the interest rate? 5%. On Holland, what is the interest rate here? 6%. Can you say what the home currency? Dollar. And foreign currency is NLG. The code given is direct or indirect? Direct. Direct and indirect. Direct. 1 unit of foreign currency in so many units of home currency. Innappa, right or not? Now, can you start doing the sum together? Now, first. Part A. Home currency approach. Part A, home currency approach. Part A, home currency approach. Okay. Before I put the solution, just to make you comfortable in case you forgot, now, one calculation I will do, we can understand all the remaining calculations. Tell me, spot rate. What is spot rate? 1 NLG is equal to $0.5. Now, I want 1 year forward. I want how many years forward here? 1 year forward. Now, after 1 year, you know that US interest rate, how much percent? 5%. Holland interest rate, 6%. After 1 year, 1 NLG into what? 1.06 NLG becomes what? $0.5 into 1.05. Yes or no? That means 1 NLG is equal to what? $0.5 into 1.05 divided by 1.06. Everybody accept or not? Now, like that, without doing anything great, tell me what is second year forward rate? 1 NLG is equal to what? $0.5 into what? 1.05 the whole square divided by 1.06 the whole square. Like this, I can find out the IRPT forward. I think all remember or not? Can I start doing the sum together? Now, right now. Home currency approach. Okay. Year, first column is year. Conversion rate of 1 NLG. Conversion rate of 1 NLG. NLG cash flow. Cash flow in dollars. NLG cash flow in dollars. Present value factor at 16%. What is 16%? The cost of capital of the project. If I do it in US, okay, it is present value factor at 16%. Discounted cash flow in Kena thousands. Okay, discounted cash flow dollars in thousands. Discounted cash flow dollars. I am writing in what? Thousands of dollars. K means 1000, it represents dollars in 1000. Therefore, I want a space. Can I proceed up? No. 1, 2, 3, 4, 5 years of cash flows. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. You tell and write. First year, tell me the formula. What is 1 NLG? 1 NLG is equal to what? $0.5 into. Solid 0.5 into 1.05 by 1.06. 0.5 into 1.05 divided by 1.06. 0.5 into 1.05 divided by 1.06 is equal to 0.4953. 0.4953. Tell me NLG, Netherlands Guilder is appreciating or depreciating? Today an NLG can give me $0.5. Tomorrow it becomes only how much? 0.4953. Why NLG is depreciating? Because the country is having a high interest rate, will be having a weak currency, IFM. Right or not? Now, next. Second year, tell me the calculation. 0.5 into 1.05 square divided by 1.06 square. 0.5 into 1.05 square divided by 1.06 square is equal to 0.4906. 0.5 into 1.05 square divided by 1.0 square is equal to 0.4906. Third case, tell me 0.5 into 1.05 cube divided by 1.06 cube. 0.5 into 1.05 cube divided by 1.06 cube is equal to 0.4860. 0.4860. 0.5 into 1.05 power 4 divided by 1.06 power 4. 1.05 power 4 divided by 1.06 power 4 is equal to 0.4814. 0.4814. Last, 0.5 into 1.05 power 5 divided by 1.06 power 5. 0.4769. 0.5 into 1.05 power 5 divided by 1.06 power 5. 0.4769. Please, can I proceed or not? No. If you are doing the project in Netherlands, you get the currency, Netherlands currency inflows or not? Tell me, that's right, the NLG inflows. What inflows given in NLG? Tell me the number. 400. The numbers are in thousands. Understand that? 400,000. Next what? 450,000. 510,000. 575. 650. These are home currency cash flows. Foreign currency. Foreign currency. How to convert a foreign currency into home currency? By multiplying by the exchange rate. Yes or no? No. 1 NLG is $0.4953. So 400 NLGs will become how many dollars? If I convert, how many dollars I'll be getting? 198.12. 198.12. 450 into 0.4906 gives you 220.77. That gives you 220.77. 510 into 0.4860 gives you 247.86. I think you are doing along with me or not? 247.86. 575 into 0.4814 gives you 276.81. 276.81. 650 into 0.4769 is going to give me how much here? 309.99. 309.99. 16% present value factor because dollar cash flow should be discounted at what? Dollar cost of capital only. 1 divided by 1.16. I want a number. What is the number here? 0.8621. 0.8621. Next is equal to 0.7432 is equal to 0.7432 is equal to 0.6407. 0.6407 is equal to 0.5523. 0.5523 is equal to 0.4761 is equal to 0.4761. Are you following up? Discounted cash flow will be in dollars. NLG is a dollar. What are home currency dollar cash inflows? 170.80, 170.80, 164.08, 158.08, 158.08, 152.88, 152.88, 147.57, 147.57. Please, I understood a feeling. 147.57. Tell me the total. 794.15. This is in NLGs or dollars or dollars. It's a discounted dollar inflow. Discounted dollar inflow. Can I put or not? Now. Minus. I am making investment or not? How much I am investing? 1.5 million NLG. Yes or no? I want to write it in what? 1000. It is going to be discounted inflow is 1,500,000. 15 lakhs, 1,500,000 NLG. Every NLG will become how many dollars? 0.5. I convert using what rate? Spot rate. 1,500 into 0.5. 1,500 into 0.5. Give me how many days? 750. It gives me 750. Tell me the dollar NPV is how much here? The dollar NPV is 44.15. Dollar NPV is 44.15. That is 44.15 in what? Thousands. $44,150. Now, for example, the company is having 10,000 shares. How many shares there? 10,000 shares. Quoted in NASDAQ. Yes or no? 10,000 shares quoted. Now, every share now, the share price will shoot up by how much dollars? $4.415. Innapa, right or not? Now, that's the impact on the share price. We'll do the other approach in the next class and continue this concept. Okay.